and may not be used as legal advice. You must confer with an attorney to get legal advice, but we've made every effort to make sure that the information we're providing you here today is up to date and very, very useful to you. So just want to tell you a little bit about Kirkpatrick Price in case you don't know who we are. We are a CPA firm and as well as a PCI qualified security assessor. We're fundamentally an audit firm providing both audit and readiness services to over 300 clients, mostly in the U.S. as well as Canada, Asia, and Europe. We have over 10 years of experience both in information security, audit and assurance, as well as regulatory compliance. So at Kirkpatrick Price, we have two types of people on staff. We have both regulatory, those with regulatory background and compliance expertise that perform CFPB-related type guidance. We've helped clients both create their compliance management system and develop documentation, as well as help them perform risk assessments, particularly vendor compliance management. And of course, we're an audit firm, so we perform readiness audit services and mock audit services and issue attestation reports for those who need to have their compliance management system validated by a third party. And of course, KP also specializes in information security. We perform the PCI, SSA 16, SOC 2 type audits, FISMA, ISO. Clients ask us to do HIPAA assessments, all information security focused as well. So that's a little bit about us today as we kind of walk through the webinar today. I know Joseph Kirkpatrick is going to put on his auditor hat and speak to you from an auditing perspective, which I know many of you will find very helpful today. So before I introduce him, let me just say something about our Q&A feature. Today, each of our three panelists today will be presenting some material for you. And then at the end, we've planned to have a Q&A session and apply a panelist type approach. So I want to encourage you to use the Q&A button at the top there. If you click on the little green bar there, WebEx controls, you'll see a red Q&A button. And just want to encourage you to push that and submit questions as we go through the webinar. We will have a panel type discussion here at the end and give you the opportunity to ask and get those questions answered. So let me introduce our first speaker today, Joseph Kirkpatrick. He is the managing partner here at Kirkpatrick Price. He himself is a certified specialist in data security, IT governance, and regulatory compliance. He's provided consulting and security assessments for more than 14 years. Joseph has several certifications as well. So let me introduce Joseph.
Thanks a lot, Todd. I'm getting our conversation today about vendor compliance management started by sharing some external guidance that has been published that you might find very useful in designing your own program. If you're just designing your own risk management process when it comes to third parties, or if you are looking at how you should maintain and operate that risk management process for overseeing your vendors, these are excellent resources to look at. I'm not doing a deep dive today on any one of these. I'm just here to introduce them and give a very high-level overview so that you can look into these resources later and see how they might aid you in your risk management process for your vendor compliance management function within your own organization. The 6 resources that I'm going to give a very brief overview of, the first 2 come from the OCC, that's the Office of the Comptroller of the Currency, and there was a bulletin in 2013 as well as really kind of an update to that came out in 2014. There was a news release in 2013, and all 3 of these documents really provide some very good ideas as far as how national bank regulators are viewing this issue. So if you are doing business with national banks, this would be a great resource to know, what they're expected to do and how that might flow down to you. The FDIC in 2008 put out a financial institution letter on the subject of third-party risk management that a lot of entities in the banking and non-traditional banking world find very helpful. The Federal Reserve has also put out guidance on managing outsourcing risk. And all of these organizations that you see on the screen here, the OCC, the FDIC, the Federal Reserve, the CFPB, they're all members of the Federal Financial Institutions Examination Council, the FFIEC. And they have a set of examination handbooks that are very detailed as far as how the examiners are to conduct themselves. So if it's an examiner from the OCC or from the FDIC, as an example, they will use these handbooks in order to perform their examination. And there's a section of that handbook, there is a handbook, I should say, that is titled the Outsourcing Technology Services section. And there's a lot of detail in that that's on their website and available to review as far as how they look at the outsourcing of services. And then lastly, the CFPB put out a bulletin in 2012 dealing with third-party risk management. So I'm going to briefly go over each one of these just to give you a snippet of what each one says. The first one, which is the OCC bulletin in 2013, lists these areas as what you should do when overseeing your third parties. There should be an element of planning, what kind of documentation do you put into place, what type of, what is your overall strategy of overseeing your third parties. You should have a due diligence process in selecting third parties that you are going to outsource services to. You should have some type of contract negotiation requirement in your process where you review the contract, you look at the stipulations, you make sure that the contract adequately addresses the things that you are expecting the third party to do. You should have an ongoing monitoring process in order to make sure that the responsibilities that you have provided to a third party is actually being carried out. You should have a termination process. How and why would you terminate a relationship with a third party? Oversight and accountability, which relates to that, and also just talks about accountability still rests with you. When you are performing ongoing monitoring and overseeing that relationship, you're still responsible for auditing and investigating, whether or not this entity is doing what you expect, and they have some measure of accountability and reporting back to you on those things. You have to have all of that documented, of course, and have some type of independent function within your organization to review what the third parties are doing. And so that's what the OCC talked about, that particular document. And they had a little graph in their bulletin that I found helpful. If we start at the bottom, here's this graph. Oversight and accountability is where contract negotiation and monitoring comes into play. And then as you move clockwise into the independent review section, you've got termination processes. You've got planning of how you're going to deal with this relationship on an ongoing basis, and then over to the right, documentation and reporting. You're going to have the due diligence and selection process as you add new third parties to the mix. And so that's a great document for you to find and pull up and read more about it, but that's a very quick summary of what you find in that. Then we move to the news release that they published that specifically was addressing the debt buyer issue. When a national bank is outsourcing accounts, files to debt buyers, this particular news release was related specifically to that, and it asked the national banks to establish an oversight committee to that process. And it asked the national banks to develop some type of debt buyer scorecard so that you can determine the quality and how you're going to measure the quality of that service that you are responsible for overseeing. You have to maintain account accuracy and documentation. You have to use clear, consistent contract terminology. and you have to provide sufficient documentation. So this particular publication caused a lot of conversation in the debt buying community about what was going to be expected of them and what kinds of things that those entities would have to do so that the national banks could fulfill the responsibilities that the regulators were asking them to do here. And part of what got the conversation going is on the next slide, where it said in one of the footnotes of this news release that a national bank might consider limiting the resale of debt. And it also called out the need to limit litigation strategies. And, furthermore, it just talked about maintaining quality management of information systems where the data would reside, and also conducting periodic reviews. And so a lot of people were questioning what that meant, when it talked about third-party relationships. Well, are they telling national banks to not outsource, that this is all too much trouble, and so why would we go through this if this news release is telling us to look at limiting that? And a bulletin of clarification came out, which is on our next slide, and it was 2014-37, that really clarified that and said, the intent was not to say you couldn't do that, but that you have to have a proper oversight function in place when you do outsource those files to a debt buyer, for example. So you have to make sure that appropriate internal policies and procedures are developed and implemented to govern these arrangements. You have to perform appropriate due diligence when selecting a debt buyer, and you have to ensure that debt sale arrangements with debt buyers cover all important considerations. Continuing over to the next slide there, it goes on to say that you have to provide accurate and comprehensive information regarding the debt when you sell it. You have to consider which debts are not appropriate for sale. And of course, the intent of it all along is to comply with all applicable laws and regulations. And so when you are outsourcing those things, you still have to maintain that responsibility and accountability to ensure that those outsourced relationships continue to help you comply with the applicable laws and regulations. And so that's the most recent document that has come out that's on our list today, and it did provide some additional clarity about overseeing third-party relationships when it comes to the debt buyer relationship. Okay, now I'm going back to 2008 because I wanted to represent guidance that had come from the FDIC, and they had published a document talking about managing third-party risks, and they used this graph in order to illustrate the risk management process of performing risk assessment, establishing a process for due diligence, contract structuring and review, and then of course oversight of third parties. And they also had a graph that I thought would be useful for everyone on the call today when you think about performing risk assessments of your third parties. What are the risks that you are considering? And this graph talks about the different things that are there. There's strategic risks that come into play. There's reputational issues, operational, transaction, credit, compliance, and then you have to consider what other risks might arise from having a third-party relationship. So this particular financial institution letter had a lot more information than this, but I thought this was a good overview to give you a start on what this particular document does in trying to help financial institutions think about the different risks that may need to be addressed in those relationships. The Federal Reserve, in their document, Guidance on Managing Outsourcing Risk, they also talk about risk assessment, due diligence and selection of service providers, contract provisions, incentive compensation review, oversight and monitoring of service providers, business continuity and contingency plans. That's an item that we haven't seen on some of these others yet, but of course would be an area of risk to consider. What if this third party goes out of business? What if this third party has an event that doesn't allow them to continue in their operations. Those are things that we have to consider when we get into relationships with a third party. And so that particular area was specifically highlighted in the Federal Reserve document and is an excellent resource for that. And, you know, one of the reasons that I think you see recurring themes in all of these documents that have been published, you know, from 2008 to 2014 is because, again, all of these entities are members of the FFIEC, and they do draw from the procedures that are established for examiners. You know, there is a lot of centralized data and process that exists there in the FFIEC. And so when you look at that handbook called Outsourcing Technology Services, you know, you see two main areas that are published in that document that an examiner has to determine if the institution is evaluating the quantity of risk that is present from institutions' outsourcing arrangements, and they also have to determine if the institutions are evaluating the quality of their risk management process. And the examiners are coming to conclusions about whether or not the financial institutions are addressing this in a proper way or not. And so a lot of these publications that we see issued by the FFIEC members follow the same approach and address a lot of the same areas because of the commonality that they all share from this organization and the handbooks that they follow. And then I just wanted to close my section here and giving you this overview with the CFPB bulletin that came out in 2012. And that particular document talks about conducting thorough due diligence to verify that the service provider understands and is capable of complying with federal consumer financial law, requesting and reviewing the service provider's documentation, making that a part of your due diligence process to make sure that you have reviewed what they have in place and what type of documents govern their own processes that you're going to be monitoring and overseeing. On the next side, including in the contracts clear expectations about compliance. That's an area I know when we do audits is usually a weak area for most companies. They don't have contracts with their third parties that are very clear in who is responsible for what and what specifically is going to be reported on. Establishing internal controls and ongoing monitoring to determine whether the service provider is complying with federal consumer financial law. And then finally, taking prompt action to address fully any problems identified through the monitoring process, including terminating the relationship. So I think as we went through this overview of each of these guidance documents that are out there, first of all, I encourage you to seek these out and read them for yourself, consider how you might integrate some of the ideas into your own risk management process. But I think you'll notice that there are some common themes through all of them that can be used for you to implement your own process. But it also speaks to the way we can use these publications to update our own processes. You know, how do we update the things that we've developed, you know, the systems that we've put into place to oversee and monitor our third-party relationships? What sources do we use to keep track of this? And certainly monitoring any type of releases. And by the way, all of these organizations, they put out a lot of releases. I just selected the ones that were specifically addressing third-party relationships to share with you today. But there's a lot more out there that an entity would need to be familiar with when it comes to these federal regulators and what they're thinking and what ideas are being propagated through their news releases. It's an excellent source for you to always monitor this and at least annually consider the things that have been published and provided as guidance to look for ideas on how you should adjust your own program. And I hope that you'll use these in that way and think about some of these areas that are common between all of them because I think it speaks to the importance of these areas of due diligence and contract negotiation and ongoing monitoring and the common areas that we see in all of them. So now to talk a little bit more specifically about some ideas that we want to share with you today when it comes to risk assessment. We want to welcome Brett Soldevilla. He's the Chief Compliance Officer for Security Credit Services. And prior to joining Security Credit, Brett was in the internal audit department of a global consumer and commercial services company and in the audit and enterprise risk services department of one of the world's largest professional services firms.
Lost Joseph. He's prior to joining Security Credit Services, Brett served in the internal audit department of a global consumer and commercial services company and in the audit and enterprise risk services department of one of the world's largest professional service firms. So Brett himself is a certified public accountant, certified fraud examiner. He's on the DBA Certification Council, and he's the chair of the Standards Committee. So welcome, Brett.
Thank you, Todd, and hello, everyone. So Todd mentioned I'm the Chief Compliance Officer for Security Credit Services, and an important component of my role is to ensure that we have adequate oversight of our vendors. So today I'd like to share some ideas with everyone on how to evaluate and address risks within your company and for your vendors. Joseph discussed some of the bulletins and guidance issued recently by regulatory bodies which highlight the need for assessing risk of your vendors. But it's also important to know that while the idea of assessing risk is a fairly new trend to the debt collection industry, the concept of risk management can also be traced back to 2001 and 2002 with implementation of the COSO framework and the Sarbanes-Oxley Act, or SOX, which some of you may be familiar with. COSO and SOX arose as a result of business scandals that resulted in huge losses to businesses and investors, which is similar to why we're seeing the issuance of new guidance in the debt collection industry. And I reference these guidelines as they have been around and tailored for over a decade and cover many of the areas currently being addressed by regulators in the debt collection industry. You can also find detailed examples for performing risk assessments based on these guidelines. In addition, some of the ideas that I want to share are a combination of methods used by companies across various industries, as well as ideas that were derived from requirements for the debt collection industry. But as the concept and the purpose of risk management is very similar throughout various industries, these ideas can be applied in a similar way. So there are a number of ways to analyze risk throughout your company and with your vendors. To better understand risks that are present within your company, I would recommend performing an enterprise-wide risk assessment. So to do this, you first need to gain an understanding of procedures within each department or function of your organization. This can be done through reviewing policies, reviewing process narratives, and discussions with management. You may also consider sending out a survey to your management team to question, what areas they deem high risk and what control gaps may exist. If you're using a survey, you can list various risks that are common for different departments or functions and have the respondent rate each risk on a numerical scale so that you can easily consolidate those responses. And so based on this input, you can then create an annual risk-based audit calendar. And you rate each project and scope as high, medium, or low risk. Your low-risk projects may require minimal procedures within the current year, where your high-risk projects may require continuous or at least annual procedures. It really all depends on the particular project. So as an example, and segue into the next topic, your audit calendar could be broken down by department or function. And so within a, say, compliance function, one of your projects could be vendor risk assessments, which I would consider a high-risk rating given the nature of the debt collection industry. And due to the importance of data security, especially as it relates to protecting confidential consumer information, you may need to design a risk assessment to identify data risks within your organization. Depending on your structure, a data risk assessment may also be required. For example, it's a requirement for PCI DSS compliance as well as DBA certification. In relation to vendors, this assessment can become very complex, but I just want to share a few general steps you can take to get started. The first step is listing all of your vendors and their contact information. Seems like a simple task, but the larger your company, the more difficult it may be to consolidate all vendors into a risk assessment spreadsheet. Document a description of services they provide and list data elements they access. And be sure to document any access and data elements related to confidential consumer information. Gather your agreements you have in place with your vendors and review to verify that the agreement incorporates some type of confidentiality clause. Once you verify this clause, document the dates and location of those agreements in your spreadsheet to evidence that review. And so calculating the risk rating may be a little bit more difficult, but your goal should be to factor in the likelihood and the impact of a data threat occurring. So the likelihood can consider whether the vendor has encountered any threats and the frequency of those threats, the attractiveness or the awareness of their information to the general public, and what controls they have in place to mitigate threats. So this information can be derived through questionnaires or other types of review procedures you've conducted on your vendors, as well as information that's available to the public. And so the impact may include the financial, the reputational, regulatory, or other operational impacts that a data threat could cause for your company if the vendor's data structure was compromised. So at a minimum, you need to consider the amount and the frequency of confidential information each vendor has access to. And so this directly correlates to the level of the risk related to impact. So to calculate a risk rating for each vendor, you can simply assign a number of values to the likelihood and the impact and just multiply each for a risk rating. And so based on the calculated risk for each vendor, you will need to then determine what procedures are necessary to gain comfort with the present risk. Procedures may include requesting the vendor to complete questionnaires, having the vendor submit supporting documentation such as policies, and conducting on-site audits. Next slide, please. And so, due to some of the regulatory requirements that Joseph covered, you may also need to expand the scope of your vendor risk assessment to address additional criteria. And you may even want to create a separate risk assessment for consumer-facing vendors that includes some of these additional factors. The financial statement review, you can, reviewing financials, you can score these based off of various ratios and qualitative criteria. Gross collections, this is a factor that can be used for collection vendors. The time since last audit, a prior audit score if you score your vendors, and complaints and disputes received over, say, the past 12 months. This would apply to collection vendors as well, and the Better Business Bureau rating. So those are just a few components that you could consider incorporating into another risk assessment. The next slide. And so similar to the data risk assessment, you can assign numerical values to each of those risk factors or categories we've just covered and average those factors for each vendor to calculate an overall risk rating. So in summary, the risk assessments should assist in defining the frequency and the type of procedures required for vendors. It's up to your management team to determine what procedures appropriately mitigate vendor risk. And so that was a fairly quick snapshot of how to get started with performing vendor risk assessments. So, please submit any questions you have, and we will try to address those at the end of the presentation.
Great. Thank you, Brett. Appreciate that very much. I also want to introduce to you today Tony Bailey. Tony Bailey has served as the Director of Business and Strategic Development at Cornerstone Support for the past 11 years. He's been very focused on assisting hundreds of debt buyers, collection agencies, and collection law firms with various state licensing projects. So he assists agencies in avoiding possible licensing issues in the M&A process, as well as assisting foreign agency firms in entering the U.S. market and domestic firms. So want to welcome Tony Bailey today to talk about this area of vendor risk.
Thanks, Todd. Can you hear me okay? Can you hear me okay?
Absolutely.
Okay.
Yes.
Good. Yeah, just wanted to cover just briefly the importance of third-party validation when we're looking at something licensing, which is not directly tied to the CFPB, but it is obviously an important thing that it's gained ultimate importance the last several years. 10 years ago, that wasn't as near as a big a factor when looking at different agencies, the agency that you're partnering with, or they're sending debt down the line. So what we found is doing some of these, like on the third-party auditing side, some of the things that we've seen that that has changed with some of the licensing. One of the first points I made, it is fluid, to where some of the agencies that you may look at or may provide that information, may be licensed at one point, but at 6 months, 8 months down the road, that could be a totally different story. And so a lot of those, the renewals and things come mid-year. A lot of those come toward the end of the year. And so, in the past, it was maybe, hey, send me what you have licensing-wise. But now it's more of a, from a third-party agency, let's look and see, what the reality is. And that's kind of either us or just some, like an attorney firm would come in and look at that, basically looking at what the states have there. And so basically 1 or 2 times a year should be adequate for this. Maybe one time at the beginning of the year might not be adequate, where they may be 100% in compliance, and toward the end of the year, maybe a completely different story if some are missing there. Like I said, this is not directly tied to the CFPB, but at some point it may play a factor in some of the information that the federal level will want to see. At this point, no. But what we've seen, just something from a credit grantor or a debt buyer side that needs to be aware of, is some of these things that are changing with state requirements that are changing. In the past, again, a lot of the credit grantors have taken the word of the agency, or whether or not there's exemption that's there or there's not any type of licensing there. And things are changing now, especially for some of the the debt buyers or the type of debt that's out there. One example is like the Pennsylvania collector repossessor license, dealing with different types of debt there. Or another example is Oklahoma, like supervised lender license, depending on an agency of the type of debt that they're there. So I say all that to basically say the agent or the partner, the credit grantor that's pushing those accounts down the line needs to at least have some kind of grasp at the state level what's required, what type of accounts that you're dealing with, and if something is required or not required. And you just can't be passive as much as you could back in the day. So that and whether you do it yourself, the due diligence, or have an attorney or somebody come in and at least have a fairly good grasp of what is required at the state level. And the last kind of point on this slide is just basically the old saying, trust but verify. Most agencies out there are honest with what they have. They're very truthful. But what we found, most of the agencies, when they are reporting where they're licensed and those type things, it's easy. There's so many different moving parts there. It's easy to miss 1 or 2 things there. So that's kind of where that kind of an independent audit comes in handy, to be able to say, hey, you're great in 95%, 98% of the states, but here's maybe one gap that you might have. Just an example of that, we just had someone the other day that had missed a Rhode Island registration that was with the NMLS, the National Mortgage Licensing System. So those, I say all that, just there's little things that are easy to kind of slip through the cracks sometimes. If you want to go to the next slide, just kind of shifting gears a little bit with your professional insurance, your errors and omissions insurance, looking at that's something that gets overlooked as well. Basically you just have to accept that all policies that you're dealing with are not created equal. When you're looking at your partner agencies, just some things that came to mind here that I jotted down is, the different types of policies. Yeah, maybe a $1 or $2 million type policy, but some things to consider is, are there TCPA exclusions? Are the additional insured, is the credit grantors all named on that? That may cost a little more to the agency, but that's good to look at that to make sure that you're listed on those insurance policies. And then last, the Fair Credit Reporting Act, does it cover that? Does it exclude that on those policies? And then last, the lower limits for class action claims, looking to see how much are we covered for if there's a big class action here. And then lastly, kind of the hot topic now with the Home Depot, the data breach that happened there. That's something that a lot of different agencies are looking at now, just to kind of cover on both sides to whether that covers exact data breaches. So main point there, like I said, is not all policies are the same. They're not created equal. You have as much power as you would like in that as kind of the person that's doing the validation for these policies. So it's a little details. There's a few questions you can ask in there as you look at the policy to get those answers. It'll save you probably a lot of headaches kind of going down the road. So that's basically what I have there. So thank you.
Thank you, Tony, very much. And I think you highlighting the need there to do validation is very valid. So we just want to encourage everyone to post any questions that you have. We're going to be spending some time here. I'm going to ask the panelists those questions. As those questions are coming in, I have a few takeaways and some comments I want to make about today's presentation. Number one is Joseph reviewed some of that guidance, and the guidance was being applied there to financial and non-traditional financial institutions in terms of how they evaluate vendor risk. I want you to to think about that in terms of how you then turn around and manage vendor risk. And think of it this way: if the OCC is requiring the financial institution to perform this level of risk assessment on you as a vendor, then that is the same exact risk assessment process you then need to turn around and manage to your vendors. So again, if you're a financial institution or a non-traditional financial institution, that guidance applies to you. But if you're a debt purchaser, for instance, and you're outsourcing to a collection attorney or agency, that same risk assessment process that is being applied to you really is an education process and needs to be turned around and applied directly to those critical vendors of yourself. So, think about it in terms of it flowing downhill, if you will. Another takeaway from the session today that I thought was really valuable is Joseph was reviewing the planning phase and the due diligence phase and the monitoring phase, et cetera, that specifically is required for effective vendor risk management. Just what popped up in my mind immediately was, is that documented? Is that planning process written? Is the due diligence process written? Is that criteria that you use, written? And then do you have documentation that you performed those pieces? Again, from an audit perspective, if you're being audited, you will need to produce documentation that actually happened. One of the things that I noticed here in the Federal Reserve guidance, one of the things that on one of the earlier slides, was the incentive compensation review was a key piece that the Federal Reserve highlighted. And just want to think about that for a second. That's a great example of a particular item that should be a part of your risk assessment process. Have you reviewed the incentive compensation program of your vendors, particularly those performing either litigation services for you or debt collection services? What is that incentive compensation plan for those employees who are performing those functions? And does it incent them to comply with federal law? Does it incent them to follow their data security policies and procedures, or is it exclusively based upon collection activity, for instance? And so that incentive compensation review should be a critical piece to your risk assessment process. A couple other things that I took away from Brett's session here. He mentioned it starts with listing the vendors and key contacts, and then critical data about those vendors, like the number of accounts and the dollar value there. A piece that came up in my mind as I was listening to Brett was, do you have the list of federal laws that are impacted by this particular vendor? For example, does this vendor perform credit reporting? And so if they do, then what are the questions? Then I have some supplemental questions to ask regarding Fair Credit Reporting Act. And so again, critical pieces to include in your vendor risk assessment process. So a couple of takeaways that I took from Tony's session, which I thought were really very, very helpful, was the review of my vendor's insurance policy. Are we listed in the policy? And specifically during your due diligence and monitoring, is the question you need to ask from a regulatory compliance standpoint is the consumer protected? So do they have the appropriate insurance? But is the consumer actually being protected by that insurance? If there was a breach of federal law or a data breach, is there an insurance policy that will compensate the consumer? Again, that would be a critical piece to your risk assessment process. And Tony, you mentioned cyber policy, and I thought to my mind data breach policy, something you may not be asking vendors for, but something you should to seriously consider. And Tony, your point is exactly right. Just because it's a generic, just because they have a cybersecurity policy doesn't mean it actually covers elements that are critical to your business. So there needs to be some diligence about the actual components of those policies. And then, so some real those are some things that jumped out at me as I was listening today. And so I was jotting down a list of questions. I'll kind of wrap this up, and hopefully you can submit some questions today that we can be answering today. But some critical questions I thought that might be helpful takeaways for you today. This will kind of summarize my comments today. Number one is my planning, my due diligence. For example, my risk worksheets I've performed on a vendor all written. Is the planning due diligence worksheets written? Number two, can I easily produce the documentation? For example, can I produce that list of vendors quickly and easily? Can I produce critical data on any vendor, the number of accounts they have, the value, dollar value there? Can I easily produce the confidentiality agreements for that vendor? Can I easily produce a list of federal law that's impacted by this particular vendor? Can I easily provide a copy of their insurance policy or their incentive compensation plan? Do I have that readily available? So can I easily produce that type of documentation to an external auditor? And then the last question I thought might be helpful today is my annual review of my own vendor risk assessment process itself documented? So again, you have this vendor risk management process. It does need to happen annually. It's not something, you have the onboarding due diligence, but of course, vendor risk needs to happen every year. So is that review of my actual process documented, the review itself documented? So those were some questions that I thought would be helpful for you to ask yourself to evaluate your risk assessment methodology. So we just have a couple of questions we want to ask here before we wrap up. So I just want to ask the entire panel here some questions that we have. One is, how does your risk mitigation differ based on your vendor's risk? So from the low, medium, and high. So I rank my vendor low, medium, or high. How does your risk mitigation differ from that ranking, low, medium, and high? So I just want to ask the group.
Yeah, this is Brad. I would say that, it really varies based on the vendor services being performed and, what your management team determines is sufficient to adequately mitigate those risks. So depending on the number of vendors and the resources that you have to monitor, you may consider a rotational audit plan. Some companies I've seen in the past, they audit all vendors and, internal branches annually, where some may conduct on-site audits, on a 2 to 3 year rotational plan. I mean, due to, modern day technology, there's a number of vendor audit procedures that can be performed remotely. For example, on your collection vendors, you can listen to recorded calls, you can review account notes, you can review policies and training support. But, regardless of your approach, you need to be sure that you have a well-documented methodology and incorporate some level of continuous monitoring for all vendors.
Great.
This is Joseph. I'll just add to what Brett was saying there with the different types of risk. I think the FDIC documents illustrated that. You know, when you consider, is this an operational risk? Is this a compliance risk? Todd and I were just talking earlier today about two different companies outsourcing two different types of functions to India. One company is outsourcing a service where the employees in India are working directly with U.S. consumers, whereas the other company was outsourcing something to India that could affect the information security of that company. And so those are two totally different issues, you know, two totally different impacts, one affecting the consumer directly, one affecting information security. So you would score that differently, you would look at it differently, and you know, evaluate how you should oversee that for your purposes.
Right. So a couple other questions here. One is what are you doing to balance the high cost of vendor oversight with the compliance requirements that are being pushed down to you? You know, how are you trying to strike that balance?
Well, I guess I'd say outside of just putting in more hours, you have to decide whether to handle internally or outsource or some combination of the two. So for those companies that are smaller and don't have resources to hire additional staff or outsource certain functions, I'll at least start with staying up to date with the continuous changes in the requirements. So there are various industry email subscriptions, webinars, and conferences worth attending. But to me, balancing the costs really has a direct correlation with risk management. If you developing a risk assessment will help you identify areas that require more of your attention and can assist you with organizing a timeline for reviewing those areas that define what procedures you need to perform. The risk assessment process is essentially the planning step of compliance. If you plan properly, all steps to follow should come much easier.
Right. So you essentially put your highest priority and most effort on the high risk elements, so that you're, and so forth, right? And the lower risk.
It's essentially just understanding where to focus, most of your efforts and your attention.
Right. Okay. Another question is, how can you use independent third-party audits to mitigate risk? I mean, what role do those audits play in your risk evaluation?
Well, I believe that the third-party audits of vendors can be incorporated into a risk assessment. For example, if you're reviewing, say, financial information of a vendor, I would consider their risk lower if they received an audit with an unqualified opinion as opposed to a vendor that had no independent review of their financials. Some vendors may also receive data security related audits such as PCI DSS or SSAE 16. Having these independent reviews does mitigate some of the risks with your vendors, but an independent review should be, one of several factors that you incorporate into a risk assessment.
Right, right. So another specific question related to that is, do third-party certifications limit your need to go on-site, that on-site review, which tends to be the costly piece?
I would say that it depends on the scope of the particular audit certification and how that independent review compares to the scope of your review. So if the vendor has an independent financial or data security audit, you may be able to reduce procedures in those areas, but there are also other areas that need to be addressed. And, we're beginning to see a new wave of compliance audits in the industry. So depending on the scope of these audits, you may have justification for incorporating a rotational audit plan and visiting those vendors, on a less frequent basis that receive those compliance audits. And I guess, these compliance audits, they may also be much more involved than the on-site audits you conduct. So if a vendor has received a compliance-related audit, you first need to gain an understanding of the scope and be sure it addresses your concerns before making, a decision whether or not to go on-site. But at the very least, these audits would be a favorable component in a risk evaluation of that vendor. But even if you have comfort with not going on site in the current year, you still need to continuously monitor your vendors and incorporate some type of procedures that can be performed remotely.
Right. Thanks, Brett. Joseph, do you have any comments about reviewing a third-party audit report?
I just think it's extremely important to understand the scope of a report. I think that there are cases when people accept a report and think that it means one thing to them when it didn't cover the scope that they should be concerned about. And then vice versa, sometimes there are independent reviews and audits available for review that do cover the scope of what you're looking at, and we don't look at it, we don't read it, we ignore it, and that's a mistake. You know, to ignore what's applicable and to not ignore what is applicable. So I think it's important to consider what the subject matter is of any independent reports that are provided.
Right. Yeah, I just want to echo that. You know, third-party attestation reports can be very critical, but they absolutely need to be reviewed. Are the critical risk elements that we have being reviewed in the scope of the audit, and you know, what were the results of testing for those specific risk areas, right? So it just needs to be evaluated along with all the other risk factors that you have. So I appreciate that. So one of the questions that we've gotten is, will the presentation be made available? And that's, yes, it absolutely will be. There'll be a follow-up email come out today. You will receive in that email a link to download the presentation today for use internally at your organizations. So just want to, I think that's all the questions and probably all the time that we have today. I want to give back a few minutes to everyone here before we close out the hour. Just want to thank you again all for attending today. I want to thank Joseph for presenting, Kirkpatrick for presenting, and Brett from Security Credit. I want to thank you, Brett, and Tony Bailey from Cornerstone Support for joining us today and bringing valuable content to our attendees today. So just want to thank the three of you for joining us and announce to you our next webinar topic. So today was our second installment. Our third installment for Vendor Compliance Management Series will be developing an audit framework. Many of you we've received lots of questions about, you know, what should be covered during a vendor audit. How do I develop the audit framework? And so we'll have that vendor compliance webinar in November. So just want to remind you to be looking for that invite. And of course, that audit framework is a natural follow-up to vendor. The vendor risk is where we identify risks, and audit is where we validate the key controls to mitigate those risks. So again, just want to thank you all. On behalf of Kirkpatrick Price, you know, we are an audit firm. We help companies perform risk assessments. We help we perform third-party validation audits, both for vendors as well as directly for the service provider. So if we can help you with either CFPB-related compliance and audit or information security like PCI or SOC 2, SSA 16, that sort of thing, please reach out to us. And hopefully grab my contact information on the previous page. So again, thank you all for attending, and hope you have a great afternoon.